Good morning, everyone. Welcome to Monday. Welcome to Monday Minutes. Happy New Year to all of our clients, all of our followers. It's going to be a great year, and it's off with a boom. There's no question about it. And we're going to run through some of the buckets here that we see short term and medium term. One is geopolitical, Venezuela. If you look at the geopolitical landscape over the last number of years, the markets have been fairly immune to what's going on here. When you look at the situation with oil in general, you can see how markets have reacted here. So not much of a reaction overnight, which we expected. The Fed this year, 2026, we know we're going to see changes. We're priced to come down a little bit, but the Fed speak is saying we're going to come down slowly. So we do respect that approach in terms of seeing how the data evolves over time. Obviously, this Friday, we get the employment report, and short term, the data is still going to be a little distorted until we get some clarity. Certainly some weakness on the labor side and changes to the Fed, the new Fed chair. That is in the president's hand. We would prefer something a little bit more independent, and we've been an advocate for Fed Governor Waller. But ultimately, the president needs to decide who he wants in that seat, and that's yet to come. On the economy, we're constructive. We're constructive on the economy. We think a lot of the work that was put in 2025 will come to fruition in 2026. It may not be a straight line, but we are constructive on the economy moving forward. With regard to rates, short rates, long rates, we have favored curve steepening. And the steepening has really come from the short end. It's come from the Fed coming down and bringing short end rates lower. And if you look at the long end, if you look at growth, where we think growth is going to come in, and if you look at where inflation is running, it is a little difficult right now for the long end to come down meaningfully unless something happens. And we don't want that something to happen. So what we're seeing is curve steepening. The overall rate structure has certainly come down a little bit, but not a lot. And in the end, if you look at 10-year yields in and around these levels, even if you look at mortgage rates historically, they're still at pretty good levels. We've just gotten used to a very, very low rate structure over time. So we're constructive on rates in general, and we do think rates continue to come down here overall, but that will be led more by the short end. And if the short end comes down more, then the long end will follow. So we could wind up with, a curve in 2s to 10s that looks somewhere in the range of 100 basis points. Markets in general, constructive overall. Last year was a good year. It was not an easy year by any stretch of the imagination. You had to work through that period of time in April into where we got to at the end of the year. But the president is showing a propensity here to adapt to tariff policy, which I think was the biggest disruptor in 2025. And as we head into 2026, we are constructive on markets. Volatility is certainly low across the board, but that's not unprecedented, and we can stay there for a prolonged period of time. There will be hiccups, but we're still constructive on markets. And in Washington, all eyes are on, kicking the can down the road in terms of what happened. We see another CR coming potentially at the end of this month, kick the can down the road a little bit longer until we work out these issues. So we remain very constructive on overall activity in 2026. It's early in the game here. The corporate issuance is right out of the gate, and it's going to be a very, very good year for everyone. Wishing everyone a great year ahead. I'm Greg Faranello. I'm head of U.S. rates for AmeriVet Securities.